Welcome to Insights That Matters. You know the show where we get curious about things with you, and we'll turn that into something you can use. Today we're going to do a deep dive into investing, and our guide is a legend, Peter Lynch. This is the guy who made the Fidelity Magellan Fund a huge success, beating the market like it was nothing for over a decade.
Yeah.
And get this, he thinks anyone can pick winning stocks. Even you listening right now.
That's right. Lynch's record is amazing. But what's really cool is that he's sure everyday investors can do better than Wall Street.
Okay, now I'm interested. But before we go there, let's talk about the elephant in the room.
Right.
You know, Lynch's famous saying, invest in what you know. I used to think that meant buying stock in my favorite dosa place just because I love their food.
Yeah. A lot of people think that. It's not about blindly putting money into businesses you like. It's more like using what you know to get started. Let's say you see a new clothing store in your city and it's always packed. That makes you curious, right?
Yeah.
But it's just the beginning.
So it's like a sign to look into it more. But wouldn't that lead to a lot of dead ends? I mean, a crowded store doesn't always mean a profitable business.
You got it. That's where the real work starts. You look deep into their financials. Are they making money? How much debt do they have? How fast are they growing? And that's where knowing the industry can really help you.
So it's about connecting the dots. You see a busy store, but you also understand the retail world so you can tell what's important. But why does Lynch think amateurs can beat the pros? Isn't that a little too optimistic?
Well, it's about perspective. Individual investors don't have the pressure of quarterly reports and those short-term market swings that make Wall Street go crazy. We can be more patient, letting our investments grow over time, just like a banyan tree.
I like that. Speaking of long-term vision, Lynch always said to understand a company's story. What exactly did he mean by that?
Think of it like this. You need to understand what a business is all about. How do they plan to make money? What's their growth plan? Where they fit in with their competitors. It's like putting together a puzzle to see if their plan makes sense.
So, for example, if a company's making a new app, we need to ask, is there a real need for this app? Is their technology really new or just the same old stuff? And maybe most importantly, is there a clear way for them to make money?
Exactly. And that's where your knowledge helps. Let's think about something closer to home. Imagine a company says they've changed online grocery delivery in India. Someone who knows the Indian market, the logistics, the infrastructure challenges, what consumers want. That person can quickly figure out if their story makes sense.
That's a great point. It's not just about understanding the company on its own. It's about understanding how they fit in the bigger Indian picture. Speaking of India, let's bring this back to us. Lynch loved using the PEG ratio to check out companies. How does that work in India?
The PEG ratio, or the price-to-earnings growth ratio. It's a handy tool, even in India. Basically, it helps you see if a company's stock price makes sense based on how fast their earnings are growing. Now, a low PEG doesn't automatically mean you should buy, but it tells you to look closer. Compare it to the average for their industry, see if the low PEGs is because of something temporary, or if the company is really undervalued.
So it's a place to start for a more detailed look. But besides growth potential, what else did Lynch think was important?
He was all about financial health. He always liked companies with strong cash flow, lots of rupees coming in, and very little debt. Think of it like this. A company drowning in debt might have trouble when the economy gets bad.
That makes sense. So you're looking for companies with a good story, a decent PEG ratio, and a solid financial base. Didn't Lynch also put companies into different groups to make sense of the market?
He did. He had 6 categories, each one with its own personality and potential for growth.
Okay, let's talk about those categories. What's the first one?
The first one is what Lynch called slow growers. These are usually big, well-established companies that might be growing slowly, maybe just a bit faster than the Indian economy as a whole. Think about those solid companies in sectors like FMCG or pharmaceuticals. They're not exactly setting the stock market on fire, but they often pay good dividends.
Right, so they're stable, which can be good for investors who want a steady income. What about the next category?
Next, we have the stalwarts, those dependable companies that are still growing pretty well. Think of well-known Indian companies in sectors like IT or banking. They offer a mix of stability and potential for growth.
So they're a step up from the slow growers, offering a little more excitement in terms of growth. What's next?
Now, this is where things get really interesting, the fast growers. These are the companies riding the wave of new ideas and expansion, often in new and growing sectors. Imagine those dynamic Indian companies in fields like e-commerce, fintech, or renewable energy, sectors that are booming right now. They have the potential to give you those amazing returns. But remember, higher growth often means higher risk.
That kind of growth is tempting. But I imagine it comes with its own challenges. What did Lynch say about managing the risks of fast growers?
He stressed how important thorough research is. You have to look past the hype and really study their business models, their competitive advantages, and most importantly, their management team. Are they able to carry out their big plans? Remember, not all fast growers live up to the hype.
So it's about figuring out which ones have real potential and which ones are just temporary. What's the fourth category on Lynch's list?
Next are the cyclicals. These are companies that do well or poorly depending on the economy. Think of sectors like automobiles, airlines, or manufacturing. Their performance is really affected by things like government spending, commodity prices, even the monsoon season in India.
So investing in cyclicals means you need to understand those big economic trends. It's about knowing when the economy is going to change. All right, 2 more categories to go. What's next?
Then we have the turnarounds. These are the companies that have had a rough time, but are trying to make a comeback. Imagine a company that used to be the best, but then they had problems, maybe because of internal issues or changes in the market.
So they're the underdogs trying to get back on top.
Yeah.
But wouldn't investing in turnarounds be really risky?
It can be. You really need to look into their finances and see if their plan to turn things around is good. Are they fixing the things that caused the problems? Do they have a real plan to get back their market share?
It's about figuring out which ones have a real chance to recover and which ones are just stuck in the past. Okay, that brings us to Lynch's last category.
Yes. The last one is asset plays. These are companies that have valuable assets, but the market might not be giving them enough credit. Think of companies with great real estate, strong intellectual property rights, or companies that are benefiting from things like Make in India. Lynch had another trick. He liked to see that people inside the company owned a lot of stock.
That's interesting. If the people running the company have invested a lot of their own money, it shows they really believe in it. It means their interests are the same as the shareholders. So in a way, it's like a vote of confidence from the people who know the company best.
Exactly.
This has been a great overview of Lynch's 6 company categories. But choosing the right category is just the beginning. Lynch was really against following hype. So let's talk about how he found those businesses that really last.
You see, Lynch thought that really great businesses solve real problems. They offer stuff that people really need and value. It's about looking past all the buzz and finding the companies that are built to last.
So it's about finding the companies that are solving those everyday problems that we face here in India, right? Think about companies tackling things like access to clean water, affordable health care, or dependable transportation. These are the things people will always need.
Yeah, exactly. And a lot of times, the best investments are in those companies that are quietly working on those basic needs. Even if they're not in the news every day, it's about looking past the flashy trends and finding the companies that are really making a difference in people's lives.
It makes you think, how do you sort through all the noise and find the companies that'll stick around for the long haul?
Lynch would always say to look at a company's track record. Have they always given their customers good value? Did they make it through tough economic times? How have they changed when the market changed? These are the questions that can tell you a lot about a company's toughness and how well they can adapt.
So it's about looking for the companies that can handle the hard times and come out even stronger. It's about understanding their journey, their struggles, and their successes. It's about seeing beyond the current hype and recognizing those companies that are built to last.
Exactly. It's about those companies that have shown they care about innovation, keeping their customers happy, and growing responsibly.
This reminds me of something else Lynch talked about a lot. Avoiding those hot stocks that everyone's suddenly talking about. It's easy to get caught up in the excitement. But how can we avoid doing that?
Lynch always said to be careful about following the crowd. He thought those hot stocks often get overpriced. And the smart move is to wait until the excitement dies down before you do anything.
So it's about having the patience and discipline to not jump on the bandwagon. Even when it seems like everyone else is making a quick buck, it's about taking a step back, looking at the situation calmly, and making investment decisions based on real research, not just what everyone else is doing.
Got it. It's about remembering that investing is a marathon, not a sprint. It's about building a portfolio that can handle the good times and the bad times, and give you solid returns over the long term.
And that brings us to one of Lynch's core principles, long-term investing. He didn't believe in trying to time the market, did he? It's like trying to catch a falling knife, almost impossible to get it right.
He definitely didn't. Lynch believed that trying to guess what the market's going to do in the short term is a waste of time. Instead, he was all about a more disciplined approach. Find those great companies, the ones with strong fundamentals and a good growth story, and hold on to them for the long haul.
It's about trusting in the power of compounding, like a tiny seed growing into a giant tree over time. Our investments can really grow if we give them the time and space to do their thing.
Exactly, and that's especially true in a market like India, which is expected to grow a lot in the coming years. By investing in the companies that are ready to benefit from that growth, we can be a part of that incredible journey and build long-term wealth.
It's inspiring, isn't it? This idea that we as everyday investors can be part of that growth story, that we can be a part of something bigger than ourselves. It's about believing in the future of our economy and the companies that are driving that progress.
It is, and that's what's so cool about investing. It's not just about making money. It's about being part of something meaningful, something that's changing the world around us.
Now, we've talked a lot about using Lynch's principles in India, but he also said it's important to keep learning. How can investors stay up to date in a market that's always changing so fast?
Lynch read all the time, always looking for new knowledge and ideas. He believed that the more you learn, the better you'll be at making smart investment decisions. He'd always say, the person that turns over the most rocks wins the game.
I like that. It's about always exploring, researching, and getting a better understanding of the market. It's about being curious and never stopping learning.
And it's not just about reading books and articles. It's about talking to people, going to industry events, and staying on top of the latest trends. We have so much information available to us these days.
It's about being proactive and taking charge of our financial education.
That's right. We have online forums, financial websites, podcasts like this one. There are tons of resources out there. And with a little effort, we can all become more knowledgeable and confident investors. It's empowering, isn't it? This idea that we don't need a fancy degree or a Wall Street job to be successful at investing. It's about being willing to learn, to adapt, and to keep getting better at investing.
It is, and that's what Peter Lynch left us with. He made investing less mysterious, so everyone could understand it. He showed us that success in investing isn't about luck or secret information. It's about the basic principles we've been talking about today. Understanding businesses, managing risk, and having a long-term vision.
And it's about believing in ourselves, in our ability to learn and grow as investors. It's about taking control of our financial futures and deciding where we want to go.
Wow.
It's been really interesting learning about how Peter Lynch thought about investing. From investing in what you know to understanding a company's story, we've uncovered so much. And what really sticks with me is that he believed anyone could be a successful investor. It didn't matter where you came from. I agree. Lynch's real impact is that he gave everyday investors the tools they need. He always said how important it is to keep learning, to trust your own research. He showed us that investing isn't about having some magic formula or knowing secrets.
So what can our listeners learn from Lynch's story, especially those who are new to investing? And what can they actually do?
The main thing is, success comes from being curious, doing your research, and thinking for yourself. Work on your observation skills. Learn to analyze information and sharpen your critical thinking. And most importantly, be patient and don't give up on your strategy even when the market gets tough.
That's a great way to put it. It's a powerful message, especially in India, where a lot of people are still learning about managing their money. It's about taking those first steps, embracing the idea of always learning, and believing that you can grow as an investor.
Exactly. Lynch's journey shows us that investing isn't just for Wall Street analysts. It's for everyone.
So if Peter Lynch's story inspires you, remember, you have what it takes to be a successful investor. Start by taking that leap. Dive into the world of investing. Never stop learning. And trust your gut.
And don't forget to enjoy the ride. Investing can be really interesting and make you money, too.
It's about more than just making money, though. It's about being part of the growth of companies in the economy.
Yeah, it's about being part of something bigger than yourself.
If you like this deep dive into Peter Lynch's wisdom, make sure to like and subscribe for more insightful content. We have a lot more deep dives coming up, exploring all kinds of topics that matter to you. Until next time, happy investing.